Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Royal Caribbean Group was founded in Miami in 1968 and has grown into the world's second-largest cruise operator by revenue. It owns 3 distinct brands targeting different guest demographics and price points.
Royal Caribbean International serves the mainstream market. Celebrity Cruises targets the premium tier. Silversea is the ultra-luxury brand with expedition cruises to remote destinations. 3 brands, 1 parent company.
The biggest strategic differentiator is private destination ownership. Perfect Day at Coco Cay in the Bahamas is a company-owned island that guests visit exclusively through Royal Caribbean, keeping shore excursion spending on the Royal Caribbean P&L.
That own destination model is a genuine competitive moat. Carnival and Norwegian cannot put their guests at Coco Cay. Royal Caribbean captures both the ticket revenue and the island spending in a fully closed loop.
Ship scale economics drive margin improvement. Larger ships spread fixed port, crew, and overhead costs across more guests. Each new ship generation drives cost per available passenger cruise day lower.
Occupancy consistently running above 100% reflects the industry's double occupancy baseline. When Royal Caribbean reports 108% occupancy, ships are sailing with more than 2 guests per cabin on average.
Net yield, revenue earned per available passenger cruise day after direct costs, is the key profitability metric. At around $230 per APCD and trending higher, Royal Caribbean's yield expansion story is intact.
The pandemic nearly destroyed this business. Operations were suspended for over 15 months from 2020. Royal Caribbean absorbed enormous losses and emerged with a more leveraged balance sheet that required years of repair.
Jason Liberty became CEO in 2022 as the fleet restarted. His trifecta strategy targets specific financial milestones: earnings per share, return on invested capital, and leverage reduction, each of which drives shareholder value.
On the competitive landscape, Royal Caribbean, Carnival, and Norwegian compete as the 3 publicly traded operators. Royal Caribbean consistently demonstrates the strongest financial performance and the most aggressive capacity investment strategy.
The dividend was reinstated in 2024 following balance sheet repair. Management prioritized debt reduction and buybacks before rebuilding the pre-pandemic dividend level, a prudent sequencing given the leverage inherited from the suspension period.
Royal Caribbean operates across 7 continents with itineraries in over 240 destinations. The Crown and Anchor loyalty program has over 30 million members, a retention engine that makes repeat guests the default customer profile.
New ships under the Icon and Star class are the largest ever built, designed around onboard entertainment, restaurants, and experiences that generate revenue beyond the base ticket throughout the entire voyage.
The structural demand thesis is that cruising remains underpenetrated relative to land-based vacations. With only 3 to 4% of North Americans taking a cruise annually, substantial addressable market remains to convert.
That's the company chapter for Royal Caribbean Group. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
$3.60. That is what Royal Caribbean delivered in first quarter earnings per share versus a Wall Street estimate of $3.24, an 11% beat in a quarter that is traditionally the cruise industry's weakest period of the year. Let that sink in. This is not a company quietly matching expectations. This is a company systematically dismantling every bear thesis that has been lobbed at the cruise sector since COVID. The debt is too high, demand will fade, younger consumers do not cruise. One by one, Royal Caribbean has answered each of those arguments with numbers. Record bookings, record pricing, new ships that are selling out before they are even christened, and a private island experience that is charging 30 to 40% more than a standard port call, and guests keep coming back. This is a travel story unlike anything else in consumer discretionary.
Royal Caribbean Group is the world's second largest cruise company by capacity, operating three primary brands: Royal Caribbean International, Celebrity Cruises, and Silver Sea, which serves the ultra-luxury segment. The company carries a market capitalization of approximately $71.8 billion and competes directly with Carnival Corporation and Norwegian Cruise Line Holdings. The business model is built around owning and operating cruise ships that serve as floating resorts, combining transportation, lodging, dining, entertainment, and shore experiences into a single bundled product. Revenue comes from passenger ticket sales and onboard spending. The company's strategic framework, called the Trifecta Program, set ambitious targets of $20 or more in earnings per share and greater than 20% return on invested capital. That program has now evolved into what management calls the Utopia strategy, targeting continued earnings expansion through new ships, private destinations, and pricing power.
First quarter 2026 results were a clear beat on both top and bottom lines. Earnings per share came in at $3.60, 11% above the consensus estimate of $3.24. Revenue for the quarter reached $4.46 billion. The beat reflects the combination of record ticket pricing, strong onboard revenue, which includes everything from dining packages to shore excursions to casino spend, and load factors that are running above pre-COVID levels, even at significantly higher prices. That last point is worth repeating. Royal Caribbean is filling its ships at higher occupancy rates than before the pandemic, and at prices that are materially above where they were in 2019. The conventional wisdom was that you could have one or the other, high prices or high load factors. Royal Caribbean is demonstrating that the demand for premium cruise experiences is deep enough to support both simultaneously.
On the income statement, the revenue growth story is anchored by two primary drivers: ticket yields and onboard yields. Ticket yields measure the revenue per passenger per day from ticket sales, and they have been consistently ahead of management targets. Onboard yields, the spend per passenger per day once guests are on the ship, have been even more impressive because they represent high-margin incremental revenue layered on top of the fixed cost of filling a ship. Gross margin improvement has been significant as the fleet has absorbed the post-COVID fixed cost base and operating leverage has kicked in. Operating expenses include fuel, labor, food and beverage, and port fees. The company hedges a meaningful portion of its fuel exposure, which provides some insulation from oil price volatility. Net margin expansion has been one of the defining financial narratives for Royal Caribbean over the past 2 years, and the first quarter results suggest that trajectory is intact.
The signature deep dive for Royal Caribbean has to be Perfect Day at Coco Cay, the company's private island destination in the Bahamas. This is not a beach you can visit any other way. You can only access it on a Royal Caribbean ship. And that exclusivity is worth something. Itineraries that include Coco Cay command a 30 to 40% pricing premium compared to equivalent itineraries that stop at Nassau or Freeport. Guests love it. Net Promoter Scores are off the charts. The company is expanding the island to add more capacity, and management has repeatedly cited Coco Cay as the proof of concept for a broader private destination strategy. Royal Caribbean is now developing additional private island experiences in other regions. The strategic logic is elegant. You take the highest friction part of a cruise itinerary, the port stop where revenue leaks to local operators, and you convert it into a fully owned, fully controlled, high-margin experience that generates revenue for the company.
On cash flow and the balance sheet, the honest assessment is that Royal Caribbean remains a highly leveraged company. Total debt sits at approximately $20 billion, a legacy of the COVID years when the company took on significant borrowings to survive the complete shutdown of global cruise operations. Free cash flow has improved dramatically as operations normalized and earnings recovered, and the company is generating meaningful cash that it is deploying toward debt reduction and fleet investment. Capital expenditure is elevated because Royal Caribbean is in the middle of a significant new build cycle. The Icon class and Utopia class ships are expensive to build, but they arrive with fully sold-out inaugural seasons at record prices. Debt to EBITDA has been moving in the right direction, as EBITDA grows, but the absolute level of leverage remains a structural risk that differentiates Royal Caribbean from more conservatively financed travel and leisure companies.
On capital allocation, Royal Caribbean's priorities are debt reduction, fleet investment, and eventually returning capital to shareholders. The company reinstated its dividend following the COVID years and has been moving in the direction of buybacks as its balance sheet heals. Management has signaled that as leverage continues to decline and free cash flow grows, shareholder returns will become an increasing priority. The guidance picture is constructive. Management has been raising full-year earnings per share targets as booking trends remain strong and pricing holds above expectations. The Trifecta and Utopia strategy frameworks have given investors a multi-year earnings roadmap, and the company has been executing against those targets. The capital intensity of the new build program is real, but each new ship arrives generating revenue immediately, given the fully booked inaugural itineraries that have become standard for Royal Caribbean launches.
Management commentary on the first quarter call was notably upbeat, with executives highlighting several key catalysts. Booking trends for the remainder of 2026 are running at record levels, both in volume and in average ticket price, suggesting that the demand environment remains robust. Management noted that the demographic expansion of the cruise customer base is continuing, with younger consumers and first-time cruisers representing an increasing share of bookings. This is strategically important because it expands the long-run addressable market rather than simply pulling forward demand from existing loyalists. The Icon of the Seas and Utopia of the Seas ships have generated extraordinary attention and marketing value through their sheer scale and novelty. Management also highlighted progress on the private destination strategy beyond Coco Cay, with new developments in progress that follow the same high-margin captive revenue model that has made the Bahamas Islands so successful.
The analyst community on Royal Caribbean skews notably more bullish than on most travel names. The consensus rating is buy, and a strong buy at that, with price targets centered around $258 against a current price near $230. That is roughly 12% implied upside on the price alone, plus whatever earnings estimate revisions follow if management continues to beat and raise. The bull camp on the street argues that Royal Caribbean is in the early innings of a sustained earnings recovery cycle, that the Utopia strategy targets are conservative, and that the private island model represents a genuinely new revenue layer that is not fully reflected in current consensus numbers. The bear camp, a smaller contingent, worries about the debt, about consumer spending durability, and about geopolitical risks to itinerary routing. For now, the bulls have had the better of the argument.
On valuation, Royal Caribbean trades at a forward price-to-earnings multiple that reflects its growth profile rather than its sector classification. Cruise lines sit at an unusual intersection. They carry the capital intensity and leverage of a transportation or real estate company, but the earnings growth trajectory of a premium consumer brand. The consensus price target of approximately $258 implies the stock remains undervalued relative to what analysts believe the Utopia strategy can deliver. EV to EBITDA analysis is complicated by the debt load, but as EBITDA grows and the trajectory has been steep, the leverage metrics improve simultaneously. At roughly 20 times forward earnings, the stock is not cheap by traditional travel sector standards, but the earnings growth rate justifies a premium multiple if management continues to execute. The valuation debate ultimately comes back to how much of the Utopia strategy gets priced in before earnings actually arrive.
The first bull case is that the cruise industry is experiencing a structural demand upgrade that will persist for years. The post-COVID consumer rediscovered experiential spending and has shown a persistent willingness to pay for it. Royal Caribbean has positioned itself at the premium end of that trend, with ships that are genuinely unlike anything else in the leisure market. Think water slides, ice skating rinks, neighborhood districts, and surf simulators on a vessel the size of a small city. The addressable market is large and underpenetrated. Cruising still accounts for a small share of total vacation spending globally, and Royal Caribbean is actively converting first-time travelers who would previously have chosen a land-based resort. Each convert represents a repeat customer with potentially decades of cruise vacations ahead of them.
The second bull case is pricing power through private destinations and vertical integration. Every additional private island that Royal Caribbean builds is an asset that generates high-margin revenue exclusively for the company. Revenue that does not go to port authorities, local taxi operators, or independent tour operators. CocoCay has demonstrated that guests will pay a premium for the certainty, safety, and quality of a company-controlled destination, and the pricing data confirms that premium is real and durable. As Royal Caribbean expands this model across additional regions, the structural revenue opportunity compounds. Simultaneously, the company's investment in onboard technology, dynamic pricing for dining packages, shore excursions, and entertainment, is extracting more value from each guest visit. The combination of higher ticket prices and higher onboard yields per passenger creates a multiplicative revenue effect as the fleet grows.
The third bull case is the new build fleet as an earnings catalyst. The Icon class and Utopia class ships are not just bigger versions of old ships. They are entirely new product concepts that command significantly higher ticket prices because they offer experiences that cannot be replicated on older vessels. Each new ship that enters service represents incremental capacity being added at premium pricing on top of an existing fleet that is already running full. Royal Caribbean has a visible new build pipeline for several years, and every ship has historically sold out its inaugural season before it even hits the water. That is unusual in any industry, having your newest, most expensive product fully pre-sold before delivery. It speaks to the strength of the brand and the pricing power that comes from genuine product differentiation. As the new build program continues, it continuously upgrades the average revenue quality of the fleet.
The first bear case is balance sheet vulnerability in an adverse economic scenario. $20 billion in debt means that any meaningful deterioration in demand, a consumer recession, a health scare, a significant geopolitical disruption, would hit Royal Caribbean disproportionately hard. Unlike a software company that can cut costs quickly when revenue drops, a cruise line has a large fixed operating structure, ships that must be crewed, maintained, and insured regardless of occupancy. The COVID experience showed how brutal the downside can be for a highly leveraged operator with high fixed costs and zero revenue. Royal Caribbean survived that episode, but the debt it incurred in doing so is now the primary financial risk. Investors need to assess whether the growth trajectory is durable enough to continue reducing that leverage before the next macro shock arrives.
The second bear case is fuel cost and geopolitical route disruption risk. Cruise ships are massive consumers of fuel, and while Royal Caribbean hedges a portion of its exposure, a sustained spike in oil prices would pressure margins meaningfully. Beyond fuel, the geopolitical environment creates real operational risk for itinerary planning. Red Sea route disruptions have already affected repositioning costs for multiple cruise operators. Panama Canal constraints affect transit schedules. A flare-up in any of the regions where Royal Caribbean operates, the Mediterranean, the Caribbean, Southeast Asia, could require abrupt itinerary changes that disappoint guests and damage pricing power for affected routes. These risks are not hypothetical. They are recurring features of operating a global fleet of large ships. The premium brand positioning that supports high-ticket prices can erode quickly if guests associate Royal Caribbean with canceled ports or rerouted itineraries.
Pulling everything together, Royal Caribbean delivered an 11% first-quarter earnings beat, driven by record ticket pricing, strong onboard revenue, and above pre-COVID load factors. A combination that defies the conventional trade-off between volume and price. The private island strategy, the new build pipeline, and the demographic expansion of the cruise customer base provide a credible multi-year earnings growth story that the analyst community has largely endorsed, with a strong buy consensus and a target near $258. The risks are genuine: leverage, fuel, geopolitical disruption, and consumer spending durability, and they warrant ongoing monitoring. But the evidence from the first quarter suggests Royal Caribbean is not merely riding a post-COVID wave. It is building structural advantages that should compound over time. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.